Hey, welcome back to Compounding Quietly. Most investors who layer leverage into their portfolio are not building a better strategy. They are building a louder one. QLD and QQQI together versus QQQ alone. That difference matters more than the return charts suggest. Let's think through this carefully. The combination of QLD and QQQI has been circulating in investor communities for good reason. On the surface, the logic is clean. One position amplifies returns in a rising NASDAQ. The other generates consistent income through a covered call structure. And the act of rebalancing on a fixed schedule is supposed to smooth out the volatility. It is also supposed to capture a small return premium between the two positions over time. That's the pitch. And it's not an unreasonable one. But before comparing this to a simple QQQ-only approach, there is a more basic question to answer. What are you actually optimizing for? Some investors want total return above all else. They want the ending number to be as large as possible, and they accept volatility to get there. Others want income, a consistent cash flow that arrives, regardless of what the market is doing month to month. Others want behavioral simplicity, one position that requires no maintenance, no rebalancing decisions, and no structural complexity to track. Most investors, when asked directly, say they want all three. That's understandable. But every additional layer you add to a strategy, leverage, income overlays, rebalancing schedules, is also an additional layer of behavioral demand. And behavioral demand compounds too, just not always in your favor. Every time the market enters a sharp drawdown, investors running a multi-position strategy face a decision that QQQ-only investors do not face. Do you execute the rebalancing now, when one side of your portfolio is bleeding? Or do you wait for things to stabilize and risk missing the rebalancing window entirely? That decision, made under real financial pressure, is where most complex strategies fail in practice. Not because the strategy was designed incorrectly, because the investor was not prepared to execute the exact move. The strategy requires at the exact moment it is hardest to make. That is the starting point for this comparison. Let's break down what each instrument is actually doing, and why that matters for your judgment. QQQ is the straightforward case. It tracks the NASDAQ 100 index with no leverage, no income overlay, and no structural complexity. When the index rises 10%, your position rises approximately 10%. When the index falls 20%, your position falls approximately 20%. There is no decay, no cap, and no maintenance required. For investors who want long-term, unmodified exposure to the NASDAQ 100, QQQ is not the boring option. It is often the most durable one. Most investors who abandon QQQ during a major correction and switch to something more complex did so because they misread simplicity as underperformance. They were not wrong about the market. They were wrong about their own patience. QLD operates differently. It is a 2x daily leveraged ETF, designed to deliver approximately twice the daily return of the NASDAQ 100. On any single day, that leverage functions as advertised. But over weeks and months, especially in volatile or sideways, markets a structural drag called volatility decay begins to work against the position. Here's what that looks like in practice. Imagine the NASDAQ 100 drops 10% on a Monday. QLD loses approximately 20%. The following day, the index recovers 11.1%, just enough to return to where it started. QLD gains approximately 22.2% off the lower base, but that gain, on a reduced starting value, does not bring QLD back to its original level. The math leaves it slightly short. Repeat that pattern across weeks of back-and-forth market movement, and the decay becomes material. In a steadily trending market, QLD performs close to its advertised 2x exposure. In a volatile, mean-reverting environment, the decay quietly narrows the advantage. That kind of environment, choppy and range-bound, describes a meaningful portion of most years. QQQI takes the opposite structural approach. It sells covered call options on the NASDAQ 100 to generate high monthly income distributions. That income is real and consistent. An investor holding QQQI receives cash regardless of whether the market is up, flat, or modestly down. In a slow or declining market, that income stream often allows QQQI to match or outperform QQQ on a total return basis. But in a fast-moving bull market, the covered call structure creates a ceiling. When the Nasdaq 100 rises sharply, it pushes beyond the strike price of the sold calls. Everything above that strike belongs to the option buyer, not to the QQQI holder. An investor who held QQQI during a quarter where the Nasdaq 100 gained 15% may have captured only a portion of that move. For an income-focused investor who values monthly cash flow over maximum appreciation, that trade-off is acceptable. For an investor who wants full participation in a Nasdaq bull run, it is not. Now consider what the 50-50 combination with periodic rebalancing adds on top of all this. When QLD outperforms in an upward trending market, you trim it back to 50% and redirect the proceeds into QQQI. When QQQI outperforms in a flat or declining market where income dominates, you trim it and add back to QLD. This mechanical structure is designed to buy low and sell high systematically, without requiring any prediction about market direction. There is solid logic behind this approach. When two assets are volatile and move with some independence from each other, disciplined, rebalancing between them can produce a meaningful return advantage. That advantage compounds quietly over time. Some refer to this as volatility harvesting. The principle is sound. The execution, however, demands something specific from you. The rebalancing moment that creates the most long-term value is almost always the moment that feels the worst in real time. When Queensland has declined 30% and QQQI is generating steady income in a sideways market, the strategy asks something of you. It asks you to sell the position that is working and add to the position that is not. Most investors understand this logic when they read it. Considerably fewer can execute it without hesitation when real money is involved. The hesitation is not a character flaw. It is the default human response to financial loss. But it breaks the strategy at exactly the moment the strategy needs to be followed. Coming back to where this started, this is not a question of which approach wins on a historical chart. It is a question of which approach you are capable of following under conditions you have not yet experienced. So how do you decide? Start with a behavioral question before you look at performance data. Can you rebalance a leveraged position after a 30% drawdown on schedule without hesitating? Can you sell the side of your portfolio that is working and add to the side that is not every time the rebalancing window arrives? If the answer is yes, and you understand volatility decay and covered call mechanics at a structural level, the QLD and QQQI combination has a legitimate framework behind it. If the answer is uncertain, or either of those concepts still feels abstract, QQQ remains the cleaner path. Full Nasdaq 100 exposure, without the behavioral complexity layered on top. Think about an investor who began the QLD QQQI strategy in early 2022. The Nasdaq declined sharply that year. QLD amplified every leg of the move down. QQQI provided income, but also participated in the drawdown. For investors who understood the structure and rebalanced on schedule, that year built long-term positions at lower prices. For investors who paused the rebalancing or stepped away from the strategy entirely, that year simply meant losses with added complexity. A simpler strategy that you can hold through a 40% drawdown without second-guessing is not a lesser strategy. In many cases, it outperforms a more sophisticated strategy that breaks at the first real test. That is not a hypothetical. That is the historical pattern. There is no single correct answer to the question this video started with. There is only the answer that fits your criteria, your time, horizon, and your honest read of your own behavior under pressure. The strategy that survives the moment you most want to quit is the strategy worth building. The criteria don't change with the market. That's the whole point. Compounding quietly. Slow, steady wealth building. If this helped, subscribe and leave a like. Everything here is for informational purposes only. All final decisions and responsibilities remain with you. Thanks for spending time with Compounding Quietly today.